Good evening. Ira Epstein with your financial market wrap-up for a crazy, active, wild week. And this is Friday, the 4th of February, 2022. We're sitting here right now about 6:15 p.m. Central Time. What a day. What a craziness. I mean, so much went on this week that you have to digest it all. One of the things that's happening is you're going to get a crowded trade. You know what that is? That's when everybody's going the same way in the bonds and the notes because all the pros are piling in. We now are saying that there'll be rate hikes every month, high probability of it, into about a 34% chance of it come February. So month after month, meeting after meeting. Okay, I've seen that story before where everybody, maybe they get right, but if they get wrong, if the market inflation slips back because the supply chains are filling, if there's so many ifs, if there's another variant of COVID that upsets the economies of the world, so many things. If the Ukrainian situation creates and turns into something even more, there's all that. But for the time being, I think those people are right. You know, we have to build that there's interest rate hikes coming. How many? That's up in the air. Trying to project out from this February to next February, God bless you. When you look at the energy markets, they are certainly high, strong. Everybody's talking the $100 area. Can't argue it, but you'll see in a moment here, you're in dangerous territory there. In the metal markets, inflation is definitely grabbing a bit of a bite. Copper didn't do as well as it could have. It couldn't hold over that 450 level. I would have liked to have seen that. In the euro, obviously, we got a big surprise yesterday this week, and that was yesterday when Ms. Lagarde completely deviated from what had been the prepared text and flip-flopped. Now we've got just like the Fed. Okay, they flip-flopped. Inflation is much more serious. The market's looking at how to deal with it. We'll keep buying the bonds and so on, but we got to look at this, and maybe later in the year there's going to be a hike when they first said there wouldn't be a hike. When we go to the S&P, obviously this market got rocked this week by Facebook, the largest big decline, I'm talking dollar decline, we've ever seen in a stock take place in one day. Yet the market, okay, we've done some damage. We are off those highs. We're at 44.92, so we're roughly, in round figures, 260 points off the highs. Okay, we're not under an 18-month moving average, so the longer-term picture isn't yet impacted. When we go to the weekly chart, it is impacted, and I told you earlier on, when this market got down, and not here, but this week, and didn't bounce back immediately the way it had done back here, I was concerned. And back here, I was concerned that there's something different happening. And I said this could be a watershed event, and it was. This is where the market has changed its character, that the Fed no longer has the market's back. Not in any manner. Now the Fed is the one, are they going to put brakes and hurt the economy, or can they, if you will, finesse this enough for a soft way to do it? That's going to be the biggest question the market has. Today's jobs data, I looked at it, I'm bewildered. How could all the pros be that wrong? I mean, you're looking at something 4 times the amount that was some of the guesses. Then I looked at all the revisions. Why are we getting all these revisions? I mean, if you go to June and July, you see massive downward. Then you come to November, December, monster upward. They're not like they're off 10, 20,000. They were 2-3 times off. That's a huge amount. I'm not quite certain if this goes on that you should pay attention to this. That becomes the bigger problem. What do we pay attention to? Because when data's that far off and the market's counting on the data to be accurate and it's not, very quickly it needs to be repaired. How are they going to repair it? I'm not the one that does those census calls and so on, but they should find a better way to do it, or some new service. There's an opportunity to create a business. In any case, when you look at the chart, certainly the bias is down. The market went down. You're under the 18-week average of closes, and as you can see, staying there. If you rally strongly, maybe you get back to the 45.90 level, but that should be a resistance point in the market. Then we get to the weekly bar chart. And I hope you like the size that I've made them. They're easier to read, and it took me a while to get to that, but they're done now. And as you can see, you've got a pattern of a higher high and a lower low. You went into what I call a vertical price break. And let me show you what that is. A vertical price break can start as a normal price break in a market. And when you take this out, then you're creating a little different situation. But now you're getting every week a big decline until this week. So you went from roughly 48.0850 to 42.12. That's almost a 600-point decline straight on down without even a bounce in the market. I'll call that a vertical break. Where's the resistance? Right in front of you. The 18-week average of closes should be enough of a number to halt this market at this point and make it think what it's doing. That doesn't mean it has to think to be bearish or bullish, but you're up to that point where the neutral territory is coming in. Where did the market stop on the upside and downside? Bollinger Band top, Bollinger Band bottom. Logical, fit in perfect. Are we trending? Not really. You have a pattern of a higher high and a lower low. From this, the trends will set up. But it's not uncommon to get that type of break as you step out of an event, and now the market tries to get back to a neutral territory and figure out what to do next. In terms of momentum, it's been coming down. It's pausing, but it hasn't turned up. The red line hasn't crossed the blue line, so you're just in a pause at this point. The Dow, same identical thing. You peaked out, as you have been doing, against the upper Bollinger Band. There's nothing here to say there's a problem. You have divergence, which I expect to see at times. You hit that upper band, you backed off, and if I come to the day you hit it, the week you hit it, you can see they were together. Now you're turning down as the market's turning down with it. But there's nothing on this chart that says, be careful, the whole bottom's, the rug's going to be pulled out from under the market. You come back down, now you're trading within the bands, and we were saying, okay, will it find its support there? And as it turns out, the market did find its support, and it's come back up. That's where you're at. It's not the same as the S&P. The S&P situation was a lot uglier than this situation. That is a way bigger break than the equivalent of that, and even the chart action is very different on the two. Then we get to the NASDAQ. And it, too, is more similar to the S&P. Bottom falls out of the market, goes to the lower band, can't even so far get up to the 18-week average. My fear is that the market will have a lower low this week and then just starting its way down. And how do you get short against the weekly Bollinger Band? I'm hoping we get a rally that does carry the market to the 18-week. But do I see anything on these charts at this point that is bullish? Not one thing. The question is, on the rally, do you consolidate and probably get another sell signal? That is what I'm watching. The argument against what I just said is the economic numbers are good. They're not bad. I mean, if the jobs data, forget my comments that I can't count on it, but if the jobs data is the jobs data and people take it on its face value, well, heck, people have gone back to work. They're getting off the unemployment rolls. We're seeing that. That's strong for the economy. They're going to have money in their pocket. They're going to be able to spend. We're already talking in different parts of the country. Are we going to stop wearing the masks? Was that the worst of it that we've gotten? Remember, we've peaked in many areas now in this latest variant. There'll be other variants, but a lot more people have vaccines. So we're learning to live with this. That's the thing that's going on. So the question is, with the Fed, if they tighten too much, well, that certainly hurts the economy. So they have to walk the tightrope. And they've done it before, but they have to walk it and not be wrong. They were wrong on inflation. We don't want them to get wrong on tightening. And the market's doing their job for them. The market is built in that there's 2 rate hikes, the March and the next meeting, and it's trying to convince traders there'll be a 50 basis point hike because this information that we're getting is hot information. Admittedly, it's only the first week of February. Got a lot more data to go. But you did find in the Russell, on the weekly chart, reason for the first time to say, okay, maybe the market is going to find its legs down at the combination of the 100-week and the lower Bollinger Band. That's the argument, I think, that I can start talking about. If you take out the 1892.40, then I have to look at another 100 points under that. When we look at the bonds, you're in a downtrend. Came zinging down. Let's forget what you did the past 2 weeks. There's been nothing here that's bullish. You've been in a downtrend. You've gotten yourself to the point, remember on weekly charts, we don't look at oversold, where the momentum is down. You hit the Bollinger Band, you can get a bounce there. You had that, and now you had another piece of bad information, data, in the market. That bad information being that the jobs data is so strong, and you took the market down this week 2 points, 1.61%. But this market has a tendency to not want to stay under Bollinger Bands. So I'd be looking that if you can clear last week's high, right up there at the 156.19 level, it probably means you're going to make a run back up to the, or try to get back to wherever that 18-week average is. Until that occurs, no. If you don't take that out, then you got to say, can you embed in the market and even get rates going lower? You're trying to do that now in the notes. If we take a look in the 10-year note, these numbers, both were not under 20. They got under 20 at the end of this week. You need several weeks of that in a row in order to say they're embedding. This has a tendency to not want to embed. You got to go back to last March and April, and when they embed, this is what happens, often. So if we do that, then it's even a lot higher rates on that 10-year. That's when you probably get up to your 2.25%, if that occurs. If it doesn't occur, you'll know it by the market getting back over the 128.22 and then look for a rally up there. I am not saying this market's bottoming and going back up to this level. The daily chart action, and we won't show that here, certainly looks like the sideways action that we had been in for a while is over in the market. And I kept saying, I think it's going to resolve to the downside, and it certainly has. We then get to the dollar index, which got really hurt this week because it's not by itself. We're not the only bank now that wants to raise interest rates. Bank of England's there. Out of nowhere, the European Central Bank came in, and boom. While the European Central Bank can say no, 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 that's not what the market's saying. So you went from upper band back down here. You're not in a trend. You do have support at the 200-week average in the 18. I contend that the market's got to prove itself now. If it's any good, the dollar bounces to the upside. If it's really bad, it's going to clear 94.77.5 and possibly make a run at these two numbers then, 93.92 to 93.43, the lower Bollinger Band and the 100-week average. In the eurocurrency, this is what you call going innocently in, and I want to use that word, innocently in to the European Central Bank meeting. Go back 1 week, read everything you can on all the newswire services. Widely expected that the European Central Bank's going to do absolutely nothing. They'll stick to their idea that inflation is transitory. Read their statement of the morning before Ms. Lagarde spoke. The change happened in the question and answer period as far as I'm concerned. And when I saw the question and answer period, I went, there. They have joined the U.S. There's your transition. And the market saw the same thing, and away you went. So obviously, this whole area is a lot of resistance. Getting up to those numbers, I'll stick my neck out. You're going to have real trouble at the 116 level, 116.72, the combination of the Bollinger Band 100-day. That Bollinger Band will fall a bit. So it puts really the 45-day average in the 18 as the two numbers. So anywhere between right where we're at to the, let's say, the 115.37 level, that's going to be the number. Are we going to revisit this area? I doubt it. I think you've just had your watershed event. So I think you mark on your chart that that's going to be a big number that's going to be hard to get under. It'll take some other event that we don't see on the horizon. In the Canadian dollar, the data keeps getting worse. I told you, I think it was 3 weeks ago or 2 weeks ago, there was a seasonal trade to the downside that did not work. I used the Moore Research Center. If you ever look for seasonals, it's very interesting what they publish. I use it as a tool, but I don't trade off of it. And they'll tell you the first thing, don't trade off that. Use your other tools, but be aware of what seasonals are at that market at any point in time. It actually got delayed by about 8 to 10 days, and then it all kicked in. Now, if this market clears last week's low right here, which was, 78.13, the pattern is such that you can immediately challenge 77.44 to 77.17 and a half. You can get always a head fake, but I'm looking at that as saying, okay, momentum's pointing down, the bias is down, you take out that low on this chart, boom, you start pointing right down there. I don't see anything on this chart other than getting over 79.21 and a half, let's call it 79.22, and not taking out that number that can reinstate the friendliness in the market. That could always happen, but I'm looking at both sides. Japanese yen, I've joined the bear camp. I think this market's got real problems now at this 18-week average. Why would you have to buy the yen again other than a war in the Ukraine? But why would that be so much for the U.S. dollar? Okay, and you're always looking at the dollar-yen relationship. So that's about the only thing that can get the world really scared. But we've already seen Germany. Do you know what Germany said today that they're going to send to Ukraine? Did you read the articles? Let's applaud them. They're going to send them helmets. There is no unity in the European Union. Everybody, it's not the United States of America, folks, not in any way. The pride is to the individual country, not to the, like in America. I live in Illinois. I'm an Illinois, I guess Illini is the right word, right? Illini. But I'm an American. In Europe, I'm a German. We belong to the European Union. I'm a NATO member, but I'm not going to do what you think I'm going to do. Ukraine isn't a NATO member. I don't care what's going on there. We can't do that. All the other NATO members are saying, let's send armaments. They're sending helmets. Congratulations. As you take a look at this, I'm still looking for that to be the resistance. But I do realize you're knocking on the door of a lot of support here. So you got to be careful if you're playing the short side. Bitcoin. Okay, on the daily charts, the market finally went back to the 18-day average. Remember what I told you? Be careful, that market's going to try to get there. It had to lose that embedded reading 2 weeks ago, 3 weeks ago. It took time, and it let the 18-day average of closes day fall down to it. So now I'm watching this. Now will you get the turn? That's going to be the big thing. Are we embedded? Did we ever embed on the weekly? Not there. So week one, week two, you could embed this week, or more likely, if you get a good rally and it continues on in the daily, this will lift the market and you won't have that. Then traders will say, that this is very good chance of this was your break low and it now held. Wouldn't surprise me at all. Do I think the pros got out of shorts? Absolutely. What do you do the first time you hit a lower Bollinger Band? 2 weeks ago is when they did it. That's where I think they came out of the market. Okay. The differential between Brent and WTI doesn't exist. You're at now 96 cents. Just go back to November. You were in your $4.50 difference. You've come in $3 on that. Both markets are on fire to the upside. Would I ever tell a client to buy an upper Bollinger Band? It doesn't. The time doesn't exist. And that's what they're all at. I wish them the best. On the daily charts, there's been ways to go in and out, but I would never tell a client to do that. Which brings me to just where we're at. You know, in the morning, the very first thing, I want to be the guy that you turn your attention to and go, what is Ira saying on these markets? At 5:30 in the morning now, I'm recording. We've sped up everything where I can get this stuff out earlier now, too. With new technology that we've bought and how we've revised some of the servers. So they're better. So in the mornings, I'm covering what's the day's news going to be, what's the charts look like. That is the key to everything. Then, instead of talking the generalities, I'm really saying, I think you buy here, I sell there, or you put your hands in your pocket, wait for a better pattern. There's always a better pattern coming down the road. If there's not a trade today, there's going to be one right behind it. Remember, we're looking at 40 markets. What do I care what the name of the market is? We're covering all this. It's called Where Can You Find the Opportunity? I do the same in the spiders and the ETFs at 9 o'clock. I start recording. Why? because all the economic data is out by then. The futures have made their move. Now, based on what spiders and ETFs are, many based on the futures markets, we can develop a game plan. How do you find out about everything I just said? Simply go to the website. Under the word research, it's all laid out there for you. I'm Ira. You have a great weekend. I'll see everybody come Monday.